Welcome back to Accounting 5000. We're going to do Module 23, which is the last part of Chapter 12. We're going to continue our discussion of CVP relationships, in which we last time talked about variable cost and fixed cost, and the fact that we could divide up even mixed cost into those two components. And we said that we were going to talk about how we were going to use that information in this module. So what we're going to do today is talk a little bit about changing our income statement format in such a way that we can use the fixed and variable components rather than our standard cost of goods sold operating income format. We call this revenues minus variable expenses equals contribution margin. So obviously it's called the contribution margin format. From our contribution margin we subtract out our fixed expenses and we can get our operating income. So it's just another way of taking the same information we had on our previous income statement, which was sales minus cost of goods sold minus operating expenses to get operating income. We just take those expenses and break them down into fixed and variable components. This gives us a new method of doing an income statement called the contribution statement format. Now if you look in your book at the bottom of page 424, you have a nice little chart across the bottom there that shows you how you can use the contribution statement format. You can do it on a per unit basis where you have your variable revenues per unit, your variable costs per unit, and you get a contribution margin per unit. Now notice if you do it on a per unit basis, you stop there. In the next column you can multiply that by the amount of volume that you have, which would be the number of units, and you can get a total dollar revenue, variable expenses, fixed expenses, and operating income. Now in that particular column, you can go all the way down to operating income. In the first column, you just go to a particular unit. Unit revenues, unit variable costs, unit contribution margin. In the next column, you can do total revenue, total variable costs, total fixed costs, operating income. In the final column you can do it by percentage, but notice again you do revenues as 100%, your variable expenses as a percent, and your contribution margin as the remaining percent. So again you only go down to the contribution margin level on your percentages. So it looks sort of like a valley. You can go to the unit level, the total level, and then back to the unit level. So if you're looking at a spreadsheet on a contribution format, you'll notice that that's the way it looks. It has an individual piece, a total piece, and then again an individual piece. In your book from pages 425 on through about the middle of 427, you'll notice that they present for you a number of different ways that you can use this contribution statement format to come up with contribution operating income. And you can look at changes in such things as volume, changes in cost, to see what the results are going to be. So if you look there on 425 through 427, you'll be able to see the real-world application of some of this information. One of the things we need to discuss before we go on and work some problems is the sales mix concept, because this is going to affect the contribution statement format that we're using here. A sales mix means that a company is selling more than one product. They're selling 2, 3, 4, 5 different things. And again, go back to our McDonald's example. They're not just selling hamburgers. They're selling hamburgers, drinks, and fries. Each of those sales items has a different proportion of costs. So you will have different contribution margins for each of the products that they sell. And like we said, most firms have a lot of products, so you can have 4 or 5 or 6 or even more contribution margins per unit on different types of units. So again, if you look on page 428 of your textbook, they show you a company that has a sales mix, in this case just 2 items, and they show you what would happen if you sell 4,000 items of A and 5,000 of B, and then how you switch it around and sell 5 of A and 4 of B. It can affect your operating income. So sales mix is very important to a firm. They want to sell more of the goods that produce a higher contribution margin than goods that produce a lower contribution margin. But at the same time, they have to realize that often these types of products go together. Often you don't just buy razor blades, you buy a razor in which to put the razor blades. So even though you may make a higher contribution margin on the razor blades, you'll want to sell the razors at the same time so that they'll have something to put the razor blades in. So these things often work together. Same thing with computer equipment. Often a company will make a computer and then you can buy as an add-on an extra hard drive or an extra piece of a DVD player or something. Those may have lower contribution margins, but the customers are demanding those items and they'll be more likely to buy your main product if you offer the subsidiary products along with it. So a sales mix is a very important decision tool for managers and therefore for management accountants. So bear that in mind as we talk about the different things that we're selling and how much we're going to make on it and things like that. We have to look at how many products we have and the relationship of those products to one another. The major use of this contribution format that we've talked about is in computing what we call break-even point. So let's talk a little bit about what break-even point is. Remember, you take your sales revenue and you take your expenses and you subtract them out and you come up with a profit. Hopefully a profit. You may have a loss if your expenses are greater than your revenues. That's not a situation in which a firm wants to find itself. So companies will say, okay, how much do we have to do to at least break even? And break even means that you don't have a loss. You may not have a profit, but you don't have a loss. And that's very important for most firms to not have a loss. So they want the very minimum of activity that they want to do is to break even. Well, there are ways that you can compute the break-even point for firms. For example, you can find break-even point in revenues using that second bullet on the slide in front of you by taking your fixed expenses and dividing them by your contribution margin ratio. We'll show you how to do that in just a minute. So that's one application that you can use for contribution margin, and it's probably the most popular, called break-even point. Now you can take break-even point and modify it a little bit and come up with what we call target income, because often companies will set a goal for themselves of wanting to have a certain amount of income. That's called target income. Well, that would be their break-even point plus a certain amount of profit. So you can take the break-even formulas and simply add in the target profit, and you still have a way to compute target profit levels. For example, you could use in target income to find the target operating income, in other words, the amount of revenue you need to generate in order to have a certain net income, by taking your fixed expenses and adding that income you want and dividing it by your contribution margin per unit. Or if you want to know how many units you had to sell in order to receive a certain amount of profit, you would take your fixed expenses plus your desired operating income and divide it by your contribution margin per unit in dollars. So these are interesting things that you can do using the same basic idea of break even, but incorporating in it an idea that you want to achieve a certain amount of target income. The next topic we want to talk about in this chapter deals with operating leverage. Operating leverage will change proportionally more than changes in revenues. And what that means is that your operating income goes up or down faster than your changes in revenues. The higher a firm's contribution margin ratio, the greater its operating leverage. And in your book on page 433, they give you some good examples of how this changes. Especially relevant to you would be the very bottom of page 433 in that little box, where they talk about company A's operating leverage and company B, which has a higher operating leverage. And you'll notice that the changes there are based on their contribution margin. So again, it's another application of contribution margin to evaluating a firm internally, of course, here, looking at how well they can change their profit based on just slight changes in manufacturing or sales. That exhibit that we talked about on the bottom of 433 continues onto the top of page 434, and it gives you a better information about the operating income changes. So let's take a minute and look at some examples of how we can use all this information about contribution margin, break-even point and target income. And let's use problem 8 as our starting point. Problem 8 is near the top of page 441 of your textbook. You'll notice in the title of the problem it says calculate selling price of a new product, what if questions, and break even. Hancock Corporation has annual revenues of $275,000, an average contribution margin ratio of 34%, with fixed expenses of $100,000. Management is considering adding a new product to the company's product line. The new item will have an $8.25 variable cost per unit. Calculate the selling price that would be required if this product will not affect their average contribution margin ratio. Okay, they give you the average contribution margin ratio is 34%. So if you look at the slide we have up here, your contribution margin ratio is going to be 34%. You know that number. You know that revenues are always 100%. So what you're trying to compute then is what do these revenues have to be in dollars? Well, if your contribution margin is 34%, that means your variable expenses will be 66% because these two added together have to be 100. Well, if this is 66%, if $8.25 is 66% of something, what's that something? Well, if you go through and do your math, you find that the revenues would have to be $12.50 in order to maintain a 34% contribution margin ratio for the new product. In Part B, they say if the new product adds an additional $30,600 to their fixed expenses, how many units of the new product must be sold at the price calculated in Part A to break even on the new product? Okay, how do we calculate break even? Well, we need to know exactly what their operating income is going to be. In this case, it's going to be 0 because they're going to be at break even. So we have no target income. Our target income is 0. So that means our fixed expenses are the only thing we have to cover with our contribution margin. So our fixed expenses are $30,600. Our contribution margin per unit is $4.25. So we divide that $4.25 into $30,600. That means we need to sell 7,200 units to break even. We won't make any money, but we won't lose any money. Notice in that slide up there, all we're doing is figuring out how many units it's going to take us to pay those fixed expenses. We've already covered all the variable expenses, so we have to cover the fixed expenses. Well, at $4.25 for each unit, we simply divide that into the $30,600. In Part C, it says, if 20,000 units of the new product could be sold at $13.75 a unit, and the company's other business didn't change, calculate their total operating income and average contribution margin ratio. Okay, under the new product, they're going to sell 20,000 units at $13.75 each. They're going to have variable expenses that aren't going to change of $8.25 each times 20,000 units. The contribution margin is going to go up because they're going to sell it for $13.75, and the difference between $13.75 and $8.25 is $5.50. Their fixed expenses are going to stay $30,600. So their operating income then is going to be $79,400. The existing amount of operating income that they have $275,000, which is given to you at the very top part of that problem. You know their average contribution margin ratio is $93,500, or 34% of the $275,000. They have fixed expenses of $100,000, so currently they're losing $6,500. So what happens if you combine these two, the new one and the existing one? You get a total for the two pieces, what they've got now and what they want to add. They get revenues of both. You just add up the revenues for both, add up the variable expenses for both, the contribution margins for both, and the fixed expenses. And then you can net out the operating income from the new product against the operating loss from the existing product, and you will still have a profit of $72,900. Finally, in Part C, Part D, describe how the analysis of adding a new product would be complicated if it were to steal some volume from the existing products. Suppose that it were to steal some of the sales that they're having now. For example, they come out with a new, more improved product. So some of the people who are buying the old product say, well, I'm not buying the old product anymore, I want this new product. That's called stealing the sales. In that case, they're going to have to adjust their computations there and come up with a new contribution margin and adjust their operating income to reflect that they're going to lose some of the old sales, but that should increase their new sales. So things are going to change, and it would complicate your calculations. But you could go back to that previous slide that we showed on the screen, and instead of using the existing data, you could modify the existing data, add it to the new data, and you would have your answer on what effect it would have overall. Okay, let's look at one more. Let's look at problem 18, which is in your book in the middle of page 445. You have a company called Kiwi Manufacturing Company that makes a single product. It sells for $32. The variable costs are $20.80, and fixed costs total $47,600. Calculate the number of units that must be sold each month for the firm to break even. Now remember, break even means they don't have a loss, they don't have a profit. What they have to do is take their contribution margin and make sure that they cover their fixed costs with their contribution margin. So if their revenues are $32 and their variable costs are $20.80, each unit is contributing $11.20 to covering the fixed cost. So with each unit contributing $11.20 to covering the fixed costs of $47,600, it's going to take 4,250 units to break even. In Part B, they say to calculate operating income if they sell 5,000 units a month. Well, knowing that their break even is $4,250, you know that if they sell 5,000 units, they're going to have some income. So you simply multiply your revenues times 5,000, your variable by 5,000, your contribution margin by 5,000. Take your contribution margin of $56,000 and subtract out your fixed expenses of $47,600, and you end up with your operating income of $8,400. Now in Part C, they say, okay, calculate operating income if you're going to raise the selling price to $33 a unit, so you're going to change your revenues. Advertising expenditures are going to go up by $7,000 a month, and monthly sales volume is going to be 5,400 units. Okay, take your same format. Your revenues are $33 a unit times 5,400 units. Your variable expenses are going to stay the same at $20.80. Your contribution margin then goes up a little bit because your revenues went up, goes up to $12.20. So that gives you a contribution margin total of $65,880. Now your fixed expenses have gone up by $7,000. So they're now $54,600, which gives you an operating income of $11,280. So if that were to happen, that would be a good move. They're making more money now than they were previously. In Part D, it says assume that the firm adds another product to its product line and that this new product sells for $20 a unit, has variable costs of $14 a unit, and causes fixed expenses in total to increase to $63,000 a month. Calculate their operating income if 5,000 of the original product and 4,000 of the new product are sold each month. For the original product, use the selling price and variable cost data given in the original problem statement. So you're going to add up two things. You're going to add up 5,000 times the $32 of the original product plus $20 times 4,000 of the new product to get your revenue. Your variable costs are going to be the $20.80 of your old product times 5,000 plus the $14 of the new product times 4,000. Your contribution margin then would be the $11.20 times the old 5,000 units plus $6 times the new 4,000 units. So you would have a total contribution margin of $80,000. Your fixed expenses are $63,000, so your operating income would be $17,000. Then in Part E, they tell you, okay, switch that around. Instead of selling 5,000 of the old thing, sell 4,000 of it, and instead of selling 4,000 of the new item, sell 5,000 of it. So you're looking at product mix here. You're looking at the change in the product mix. So you need to go through and redo all your calculations. You would have $32 times 4,000 units plus $20 times 5,000 units. And as you go through and recalculate, you can see that your operating income actually drops if your product mix drops, because your previous operating income was $17,000. Now it's $11,800. So you were better off with the previous product mix. Changing the product mix actually costs you money. In 11 it says, explain why the operating income is different in D&E, even though in both cases you were selling 9,000 units. The contribution margin was different for those products. So therefore, if your contribution margin is different on each of your products in your sales mix, you're going to have a different operating income for each of those two products. It's going to change your total operating income when you have a total of your both items in your sales mix. So what we've done in modules 22 and 23 is to look at chapter 12. We've gone through and looked at dividing costs into variable and fixed components, using those variable and fixed components to come up with a new method of looking at an income statement called the contribution margin approach. Then we've applied the contribution margin approach to break-even analysis and to target income. So those are the things you need to review as you go through these two modules again. Make sure you have a good handle on those ideas, because we will continue to build on the contribution margin format and break-even analysis in the next couple of modules.